Good morning, everyone, and welcome to Weekly Profit Talk. As the name might imply, and you could gather, we do this every single week, Wednesday morning at 8:30 Mountain Time. That is 7:30 on the left coast, 10:30 on the right coast. So, good morning, welcome everyone. This week's topic is how private physicians can maximize tax savings this tax season. I can't think of a more appropriate topic now that we're basically winding up 1099s and getting all that done. Everybody's made their estimated payments. I'm certain that you've made four good payments throughout the year last year, and you're going to be looking forward to tax season and owe less than $1,000 in tax because you made good estimated payments, right? You're not sure? How long have you been watching this program? So, anyway, with January's task mostly behind us and a couple days left in the 1099 deadline season, I thought, what more appropriate topic could there be than looking forward to actually saving the most possible money on taxes? So, let's talk about that a little bit. And I got a few things to share. One thing is if you even sniff around the outside of the news or have a social media account, you're probably aware that there's a new tax reform. There was much to do to get it signed on July 4th, which was a weekend, by the way, but that's kind of the way our current administration rolls. So it's a significantly easy day to remember for obvious reasons. It's a holiday. And there are a lot of people that have quite a bit of heartburn with some of the provisions of this tax reform and what it's done for certain people. But I can tell you, for those of us in the middle to maybe upper middle class of income range, there are some benefits to it, and I want to talk about some. One of the big ones, and this is something that's got me excited for myself and most of my clients. Bonus depreciation is back. That was basically gradually declining by 20% increments. They hung around at 100% during the COVID years, 20 and 21, even though it was supposed to start declining then. And then it went down 80% 22, 60% 23, 40% in 24. And they actually voted it through. Now it's going to be at 100% and it will stay there through tax year 2029. So, what is 100% bonus depreciation? Well, that means if you purchase something that is an asset for your business, under normal circumstances, you're required to depreciate that over a period of time. I would say most things that people use quite often, physician practices, for example, and I'm thinking of equipment like X-ray machines, RFA machines, and even computers, things of that nature. These are the kind of things that have a 5-year depreciation life, well, which means that you can write it off over a 5-year period. So you spend $100,000 on something. The first year, they have a thing called half year convention, so you have to split it in half, but you get to double that anyway. So that $100,000 you write off 20,000 the first year, and then the 80,000 the next year, um, divide that by four is 20,000, but then you get to double that and write that off, and then you have $40,000 left over in year three, and et cetera. What 100% bonus depreciation does is provided that you qualify by income standards, you are able to write off that entire $100,000 in the first year. Do you always want to do that? No. One of the major reasons you wouldn't want to is that your taxes are already going to be low with a typical double declining balance depreciation over 5 years, and you don't need to do it. It could be better tax planning for you to continue to have some sort of an expense against that asset for the next several years. But there may be cases where, and hopefully this is true for as many people as I'm talking to, possible, you are maybe scaling your practice and you're making significantly more money this year than you did last year. That is always the goal. Business that isn't growing is dying, basically. And if that's the case, then you may be looking at quite a bit of revenue. And if you can write off $100,000, it could significantly put thousands of dollars back in your in your pocket. This is your money. Don't give it to them unless you absolutely have to. And they've just made it a little bit easier for us. OBBA, by the way, stands for One Big Beautiful Bill Act. So I just call it OB3 basically. And Section 179, they actually have increased the limit to 2.5 million. Phase out is $4 million for qualifying purchases. Um, that's significant. It really isn't going to be much of an issue for you unless you're in a 10 million plus practice. But still, they have raised the limits on that as well. So there's some good news for you and a lot of opportunity to save thousands and thousands of dollars. So what else can we do here? Salt became reasonable again. The previous tax reform was placed into um, the code on 2018. It was signed into law. I think I'm going to remember the date. It was December 17th of 2017. Um, our current president was also president back then, and he had guys like Paul Ryan and Mitch McConnell backing this up in Congress. They had this thing called the Tax Cuts and Jobs Act. And with that, what they had done is they eliminated personal exemptions and doubled the standard deduction. So your write-off was similar, but most people suddenly found themselves unable to itemize deductions, uh, simply because the standard deduction was twice what it was before. So people in middle income ranges that had significant property tax as well as mortgage interest suddenly found themselves unable to benefit from that. The total of those deductions was still less than the new standard deduction. So part of the problem was that they limited SALT, which is state and local tax. So this includes property taxes. There's also an IRS calculator for sales tax, and you can actually run that calculator, save a screenshot of it, and enter that in your tax returns. Not sure how to do that. There are tax experts that can help. Um, you're talking to one right now, so I'm certainly very happy to assist with that sort of thing as well. So, um, raising that tax limit, they're basically they also got rid of some other itemized deductions, but there are a few remain. One is the medical expenses deduction, but it's terrible because you have to have over 7.5% of your adjusted gross income in medical expenses before you can write off your first dollar, and most people can't take it. You have to have something like end-stage renal disease or a chronic illness to basically even benefit from that. It's very hard to write off medical. Then there was assault taxes and mortgage interest remains and charitable contributions. That's basically about all you can write off anymore. They eliminated unreimbursed employee expenses. You can't even write off tax preparation anymore. So that Tax Cuts and Jobs Act reform actually wasn't very friendly for a lot of people, but I'm jumping up and down on that because they had placed a $10,000 limit on how much tax you could write off. You enter $32,000 and your deduction for taxes would still be just the 10,000. So now, as long as it's under 40, that $32,000 is back in play again. And that can put you and your spouse over that limit and actually make itemized deductions work for you again and pay a little bit less tax. So, um, and I make a case for California, New York. I can think of other states that are expensive. Certain Massachusetts is, for example. Um, uh, but this is absolutely meaningful. And if you live anywhere else, as I said, the difference can actually clear that standard deduction bar and decrease the amount of taxable income you have after deductions. So that's big. Okay. Um, Last thing I'll talk about today, and there are some others, but I'm trying to keep this short and friendly. So, QBID stands for Qualified Business Income Deduction. They did put this in the code back in 2018, and with the new tax reform, they made it quote unquote permanent. They were talking about it repealing at the end of 2025, but they got the new tax reform through in time. So it is now basically a permanent part of the tax code, at least until somebody comes along and removes it. But honestly, QBID is pretty popular with small business people. It allows you to write off 20% of your qualified business income as an additional deduction on top of your standard or itemized deduction. But I mentioned something called SSTB here. That's specialized service, trade, or business. Okay. I'm in one, accountants, and others, doctors, lawyers, architects, professional musicians. I know there's a few others, but as basically the SSTB professions limit the amount of qualified business income that you can write off. if you have one entity and you have, as a married physician, I think the number I got in my head is about $530,000 a year. You're completely phased out of taking the QBID and you can't have it anymore. But what if you have multiple businesses? And it's just as simple as getting on your state Secretary of State website and creating a new business, organizing it as a limited liability company or a professional liability company, whatever you have to do, depending on your state. If you have separate but similar business types, but you can run them under the umbrella of another company. Um, when it comes time to do your tax return, you're not only taking that income away from your larger pool of income from your major entity, which might reduce the income down to the point where you do, in fact, requalify for qualified business income again. But the smaller entity, you certainly can. And I can tell you as a fact that you enter those business by business. So let's say, for example, you're a physician making about $1 million a year, and your main business is somewhere in the 450 to $500,000 range. So you're going to have little to no qualified business income on that. But let's say you have the time and the wherewithal to do, for example, university teaching or consultation or some combination of the above, or you break off into a separate business. Maybe you run a second business with a different partner, for example. And I can think of an example. Many states require medical practices to be at least 51% owned by a licensed physician, but those businesses might be capably ran by somebody that has a credential slightly under an actual medical doctor. In that case, the income from that business can put you back into qualified business income deductions that can significantly affect your tax. Also, there's only so much money that you're going to be able to put away for your retirement, and there are some capital investments you can do to clear current amount, I believe, on a solo 401k is about 72 or $73,000. There are some other things where you can actually put away significantly more, but there's going to be a limit on this to a certain extent, and a lot of physicians and other high income earners basically turn a real estate investment. That can take several paths. You can buy something, turn it over a property management company, and have them do long-term rentals with 6 or 12-month leases. You basically own the property, collect the rents, pay the property management, and you're able to depreciate that property, which means you're not paying much tax on it. You've already spent the money once, but you're basically in expensing something called an intangible expense at a rate of 27.5 uh, well, 1 over 27.5. And I happen to know that fraction. It's 0.3636. So if you multiply that by the total amount of the property that you purchased, you get to write that amount off every single year you own it. So between that, your mortgage interest, and property taxes, property management fees, all that, you can actually realize a little bit of profit, but pay no tax on it. And if you have a spouse that's able to spend 750 or more hours on that real estate, you can actually also take passive losses each year up to $25,000. So real estate investments are a definitely a very important and a viable avenue for physicians looking to put away money for their retirement. Um, And this last thing, yes, that's right. So let us say, for example, that you're able to invest in a commercial property that you're able to run your practice out of. If you create that as a separate entity, um, and you want to basically set that up so that that entity is charging your practice's entity a reasonable rent. So this is a win-win because your practice's entity basically has a new overhead. They're paying rent for the space. Um, you're basically making money in the other entity, but as long as that particular entity is making under the phase out amount, which is $100,000 less or about 430K a year, you get to write all of it off as a qualified business income deduction. So that's 20% of the qualified business income deduction of each entity that you own. And that's what we're talking about when we say entity strategies. So I hope these things make sense. There are a couple other things you can do. One thing I'm asked about quite a bit is I've got a teenage kid, and I'd like to get him or her uh, starting to earn some money and basically helping out with the business. They realize that they're very capable. Uh, a lot of you folks have young budding geniuses in your household, A and B students, and you want to basically teach them the value of work and earning their own money. It's a fantastic way to get them going. As long as they check the box, they're a dependent of another taxpayer, and that's you, then the income that they make um, is taxed to them. But as long as you're still paying over half their support and they live with you over half the year, you still get to write them off as a dependent. And if they make less than the standard deduction, and let me think, I think that's $15,750 in 2026. As long as they make less than that in a year, they won't pay any tax at all. That because the standard deduction will take care of it. So, absolutely win-win. They learn how to do a tax return, a simple one, albeit, but if they have any uh, withholding from their checks, by the way, for some odd reason, and they make less than that 15,750, they file their taxes and they get it all back. So, what kid doesn't like having a few hundred extra unexpected dollars? So, um, I'm asked about that quite a bit, and I applaud the idea, and I try to support it as much as I possibly can. It's just it, it's awesome. It's a great way to build families and basically create young citizens that are responsible for the future. And um, I think it's just a fantastic way to go. So if you're thinking about it and you want more help or would like to talk to somebody about it, remember, I'm coming to you one of three media here. We are on LinkedIn and YouTube as well as Facebook. And in all three of these, there's a comments capability, or you can just write help or more information or let's talk or whatever you want to say. My team will pick that up and we'll show you how you can book your first free call with me. And let's have a conversation for 30 minutes, even 45 if necessary. And let's talk about what we can do and to make your practice cash flow and tax uh, burden situation both better. So let's see if working together will resonate for both of us. Let's do that soon. So with that, I want to bid you a fond adieu to the month of January. Next week's going to be Groundhog Day, so Um, I'm always looking forward to February because in my neck of the woods, January is the coldest month of the year, and things just start gradually warming up from there. So, and also February has my birthday in it. So, just very much looking forward to that. I hope you all had an amazing January up to this point. Have an amazing day today, and if you have a chance, do something randomly kind for a stranger today. So, until next week, so long, and we will see you later.